You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody, welcome back to the Option Block, everyone's favorite. I know it's my favorite. Hopefully it's your favorite. Otherwise, what are you doing listening to us? No, just kidding. Bi-weekly source for all things options related, even if we're only your medium favorite. We still don't mind if you tune in. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If I'm talking really quickly, it means because I got to go in a few minutes. I've been called away. Other pressing duties have grabbed my attention. If you're a parent, you probably know how these last-minute things pop up sometimes, and you got to go run off and deal with them. So I'll be doing that. But before I go, of course, you guys know where to find all of our great audio. iTunes, TuneIn, Stitcher, theoptionsinsider.com, as well as via our mobile app. So hit us up there. However you get us. We're not going to do the live stream today, unfortunately, because I have to go. We run that live stream out of the studio. So no live stream for all of you who normally join us every Thursday at 3 p.m. Central. We miss you. Hit us up via Twitter if you want, or Facebook, and we'll try to get your questions into the show like usual. But, of course, I'm not leaving you completely empty-handed. No, you'll still get a show. And I'm leaving you in the capable hands of Uncle Mike Tussaw and good old Rock Lobster. Let's start with Uncle Mike. Uncle Mike, how you doing today on this fine, meatless show today?
Well, I mean, I'm going to try and work to struggle through it, but when it's 70 degrees in Chicago in November, that kind of makes life a little easier to handle.
Yeah, it is nice out here. It is nice here in almost 70 in November. Can't remember the last time that happened. Global warming, Chicago for the win. We are the new Miami, which is always nice. And we also joined, if he can figure out all of his headsets and fun, by the Rock Lobster, coming in from the land of Maine by way of OptionPit.com. Mr. Rock Lobster, are you there, sir? Have you assembled your formidable array of devices to participate on today's show?
I hope so. Can you hear me?
I can hear you for the most part, yeah. I think you'll have to do.
Okay, well...
I'm guessing Tussaw will host.
I am here. Skype is rejecting my my computer, but I am going to soldier on.
You guys got a lot of fun stuff to talk about. You got jobless claims, you got the Fed, you got a lot of earnings popping off after the bell, you got UA, tons of listener questions, I think, plus Uncle Mike's epic 38-minute strategy block that he promised us, so a lot to get to. All right. If you guys are ready, Uncle Mike, put on your big boy hosting pants because it's time for the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
And welcome to the trading block. Now that Longo's out of the room, we can say bad things about him. That's a good thing, right? No, just kidding, because he listens to the recording anyway, and he'd probably fire us if we did such a thing. But with that being said, we do have a lot to talk about today. This is going to be an exciting. Normally, this time of year, once we get closer to the holidays, usually the big debate is: Are we going to get a Santa Claus rally? Are we not going to get a Santa Claus rally? And how is Black Friday? And that's usually the two main topics, it seems, this time of year. But not only do we have an election that we're just still kind of digging our, or just trying to see what the market's going to react to, but we have a lot of interesting things based on the election with which we had. So I think that there's going to be a lot to talk about over the course of the next few weeks, starting with today. Janet Yellen was being probed by Congress today, and she had some interesting things to say. But from everything that I could tell, Andrew, it looked to me like it looks like we are going to be, it still looks likely that we're going to be having a rate hike in December. I know I predicted that we would not have a rate hike this year, but I got one more term to go. I think it still could be a possibility, but I do have to say with Trump victory and everything that's going on, I think I'm going to change my prediction now and kind of go back on my original thoughts that I made months ago. But I kind of, based on what we heard today and everything that's happening, it looks like a rate hike is imminent in the coming month. What thoughts do you have on that and some of the other anything else that's happened in the market today?
I think basically said yes, she's going to raise rates, and the bottom fell right out of volatility. It started to, this morning it was kind of wavering, and then she says, "Oh, yep, we're going to start to raise rates." And I guess now, after threatening to do it for years, the market is finally, she punch drunk the market into what is it? Obsequiousness? Is that? I'm trying to think of the word.
Obsequiousness. Nice new word.
Yeah, I don't think it's the right one. No. But I think the equity players are now like, okay, let's get back to regular because this QE stuff should be over, and enough of this big daddy government for the last 8 years, and maybe we try something else. That's kind of the thought. And you did open this phrase with Congress was probing Janet Yellen, did you not? I wasn't
did.
Quite sure. Okay, that was not the phrase I was ready for. I have to be honest with you.
Yeah, maybe probe wasn't the best choice of words, but she testified before Congress today. We'll leave it at that.
Okay. So, and stocks are still going up, it looks like. So, interest rates are still low. It looks like maybe we have some tax and fiscal policy that might make a little more sense, that might be more pro-growth, and we maybe stop this experiment where just the government jacks up the deficit. The Fed puts a bunch of stuff on his balance sheet and see if we can get growth that way. I think we tried that, and we saw what the result is. It's kind of subpar growth. So maybe we try it the old-fashioned way where businesses try to grow and make some money, and then stocks end up liking that. So I'm all for the latter. I'm not as much of a fan of the former. But that's what we have. But volatility seems to be telling the tale, and also the vol futures basically took all the uncertainty out of the rate hike, I believe, from the move today and like the D's contract. They kind of said, yeah, we don't care anymore. That's sort of what the movement in the vol futures, at least I see that as, toward the end of the day, was there's just no there is no real movement. So if something's going to make the market crack up right now, it is it does not look like it's on the horizon. I mean, I thought okay, maybe we could hold up around the 15. I mean, we were 1575 future yesterday in D's, and it's closing 1510. So there is almost all the weekly futures are now in the 14 handle. That is, that is a one-way ticket to Palookaville for volatility, at least right now. So I would not surprise me to see vol go. We could see some kind of low numbers, I think, next week, especially again if the Fed is taking out these surprises every month, or the bid for vol, that was a big source of vol bid. I thought it was a great trade. It's been a fun trade for 4 or 5 years now. And it looks like it is going away. So you might have to shift gears and just buy calls because your book is going to be timely, Mr. Tucson.
There you go. In time for the Christmas season.
Just in time. We had a bunch of people that had some long calls today. or long puts and volatility that all have, sort of sprung back to life. So you buy some puts in the vol products and some calls in equities, and oh my gosh, we have the rally. And one of my favorite sayings I think I invented is options love a bull market, mostly because volatility gets very cheap, calls have a lot of gamma, and normally buying calls are kind of crappy, but there's definitely some potential when they get them cheap enough. With the VIX down here, all of a sudden things can move. So the whole risk reward profile switches dramatically.
Yes, it does, to say the least. So with that, just one thing that I'm noticing is that we still have the thorn in the side. I can't say what I wanted to say what I want, like saying on all those shows about there's never been a better time. I just can't finish it. But I still want to point out we have not made the all-time high on the S&P as of yet. We're close. We keep getting closer and closer every day, but we have not made it. So I'd like to see, we are actually, let's see, the all-time high in the S&P I'm showing on the SPX cash back in August, on August 15th at 2193. So we have a shot at getting there tomorrow. We need around 6 points. But we still have not done it as of yet. So I think that I don't have too many more excuses not to become uberly bullish, but that's the last excuse with which I have. Now, don't be mistaken. I'm still bullish. I'm always bullish in one way, shape, or form. But I think at that point would be the time with which I would start really starting to add deltas and starting to buy breakouts along those lines. Speaking of stocks looking to go up, on here today, one thing that I've been watching, I'll talk a little bit more about on the strategy block today, IBB, the biotechs. That is another one to where right after the election, let me bring up this chart. Looking at the biotechs, obviously, when we realized that Hillary was out and that biotechs weren't going to be such a toxic thing again, we actually rallied, in IBB anyway, roughly 30 points, from 260 up to around the 290 level. We're still kind of hovering around the 290 level at this point in time. Over the course of the next few weeks, I think it's going to be interesting to see how that reacts in this. It feels like biotechs, along with financials, it's like we have a divided nation between the Hillary supporters and the Trump supporters. We now have a divided market, and that we have the Trump stocks and the Hillary stocks, so to speak, and that Silicon Valley not liking Trump so much, but we have the banks that typically like Trump. With this divided market, we are still rallying, which is good for those of us in the bull camp, but can you see much of a continuation if we have a divided market like this, Andrew? What are your thoughts on that?
Well, that's what's the weird part. Why I think you're not getting your highs. Mostly because of the tech sold off. It's kind of coming back, but it isn't to where it was. But it's made like a 4% move in the last couple of days at least, or 3.5% move. So that was not a small move at all. So that's one area. Commodities, oil looks like it's kind of making a move, but not. It was started to, and then it's kind of stalled. The financials are the one that's really been propelling the rally. It's almost been all financials, and the Russell have been. That's been the rally essentially. I mean,
we had 10% move in XLF. I mean, that's crazy.
Yeah, and then when we look at the unusual activity today, there's more crazy stuff that I've not seen since doing unusual activity, where that kind of buying anyway. So yeah, I would say there is the financials have basically, with interest rates rising, that gives banks spread ability. They're not under as much pressure anymore. And, I think it's the great unwind is coming off. Might be actually, growth in the banking sector again and financial sector, which in general is good as long as They adopt some simple risk control. That's a whole other subject for me. After 8 years after the financial crisis, the one thing I want them to do for risk control, they still have not done. But they've done a lot of other stupid stuff, but they haven't done the one important thing that really is necessary, I think. You're looking at financials kind of holding everything up, and you want tech to sort of help along the way. And most tech earnings were pretty good through this last cycle. So I think it's almost one of those where people are going to start slowly clawing their way back once they realize that it's going to be very hard for, I think mostly better tax policy if we can get it. Don't know if we can. We don't really know. But if that's on the horizon, that in general should be better for, the big multinationals that we have. So especially the technology multinationals. So we'll see, how that all plays out. As far as financials go, the one thing I've always wanted to see was I would like to see a central clearing mechanism for all over-the-counter trades, similar to the option clearing corp for options, since it basically the options clearing corp has been able to margin a contract that can go from a penny to $10. So I'm quite sure over-the-counter clearing of derivatives where they have an independent third party verifying margin and pricing, like the OCC does, would go a long way to stabilizing the market, because they basically can say somebody is getting too big and they have to scale back. Or they have to put up more margin, which generally makes people stop doing things they can't do. So I'm a big proponent of that. I'd like to see that. Probably won't see it in my lifetime, but if all of these senators and congressmen who know so much about financial regulation, I have not seen that pushed in a way that would actually be helpful. And if we do, I'd be all for it. But there you go. That's my slight soapbox.
There you go. Well, and the other thing that would help with that is that you have two sides of that coin. The one side is the bank saying we need to leverage ourselves. We need to use these derivatives so that we can function and prosper. Whereas the other side says, no, derivatives are evil. We don't understand it. What regulation do you have? If you have something like the OCC, that would solve a lot of problems.
Yes, it would.
The bank would actually be able to use their derivatives in a way that's financially prudent, to have the risk management in place, like we talk about on the show, for retail traders, and quite honestly, anyone has to use trying to trade listed options. But what that also does is that gives something to the people on the other side of the coin. They say, well, how do we know that you're not just making this stuff up in phantom pools of money and lies, cheating and stealing and that? Well, if you have something like the OCC, a central regulator in that, then I think that would be one to where it would make a lot of sense, because if they're making up derivatives on derivatives to where odds are all sorts of crazy things like banks did back in 08, well, yeah, that's an obvious problem. But on the
it would
flip side,
require a buttload of margin. So
right.
They couldn't do it.
Right. So with that, I think that would really, I agree with you, Andrew. So when you run for Congress in Maine, let me know. I will endorse you somehow.
Hey, that would be a great endorsement. I would take that. The great Tucson endorsement. So,
well, you have to run a platform of what we just discussed, and I don't know how many of your constituents in Maine are really saying, you know what, we need a third-party regulation for banks. I'm guessing that's not a hot topic at the local diner.
I'm going to say it is not. They're still trying to reel from the fact that pot's going to be legal. I got a little town of mine. Go down in this little town to the pot store. We're getting off the option topic. I'm sorry, but as far as trade goes, I'd say, get out of the way. Get out of the way of the rally right now. If you're trying to fade it and really trying to lean into it being long puts. Don't lean into it being short calls. That's all I would tend to
agree on that one. So, all right. And with that, that takes us to the end of our trading block for today, and takes us into our next segment, the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for The Odd Block.
And welcome to the Odd Block. This is the section of our show where we discuss things that seem quite a bit odd. And what I'm hoping Andrew comes up with today is a good trade that we'll make fun of and is really stupid, so that way I can join in on that trade tomorrow and make lots of money like we were talking about that trade last week. So with that, Andrew, what trades are you going to make us some money on this week?
Well, I thought probably let's hypothetically discuss how big an option trade that the first trade on the odd block is. Take a wild guess on the size of this particular trade. Just throw out a number for me. Let's say.
Okay, and folks, I don't have because normally we get show notes before the show, and just so you know, folks, I have no idea what I'm getting into here. So I'm just going to throw out a number and say that somebody did 650,000 contracts in something.
Well, actually, that's not a bad guess. 350,000 contracts went up in XLF. We were just discussing XLF, right?
Yeah.
And you would say, this is I think it's probably it's been a great put selling thing over the years after the financial crisis, but someone bought 320,000 Jan 22 calls for 72 cents with XLF trading 22.15. If it's not made a 52-week high today, it's got to be very close to a 52-week high, I would say. But one thing you don't see in XLF is somebody spending that much money. I know there was the funky dividend in there, so it's changed things a little bit. But I think dividend adjusted, it's definitely at an all-time high. But 320,000 calls purchased. Just a massive, massive, massive block of options.
So wait, which month was that?
Jan 2017.
Wow. So that's $23 million that someone's laying on the line right there.
Yeah. That is not, and so it is, and it's at the money dollars too. So I mean, they need a pretty good move to make money on these things. Wow. And I believe it went up tied with stock. It could be delta neutral or close. I only saw, again, 4.6 million shares went up. So it's delta very long still. Millions of deltas long still. But don't you find that to be a massive, massive trade?
That's a lot of calls. That's someone's 20, and that's not notional value or anything like that, folks. That's literally someone wrote a check for $23 million and said, I want these calls.
No matter how you slice it, it's a pretty big bet. What I'm thinking of is if this rate hike really happens and you start to see a pattern of rising rates, you could see another 10% out of the financials because if you think about it, they haven't. Clearly the last 2 weeks or since the election, what is that? It's only been a week. It feels like about 10 years. If you look at social media, my God, I had to stop looking at it. It's crazy. But somebody is looking for and I don't think it's as crazy a bet. I mean, it's a massive bet. I would try to find a cheaper way to do it, I think. But higher rates and a pattern of higher rates are, that should be good for banks. And somebody is making just a massive bet on that. I don't even see how this could be a short bet on XLF, even if you sold stock against it. I guess it's possible, but that is certainly, it would be cheaper just to go buy a bunch of 21 puts or something for, 36 cents, if that's really what you're looking to do. I don't know why you would backspread the at the money. The only thing I could think of is just from a vol point of view, they're very, very inexpensive calls relative to what's been happening lately. So if the pattern of activity continues, it could be the buy of the century. And we'll be both looking at each other like, oh my gosh, I can't believe the guy paid 72 cents and made $1.50 on him.
That's a nice $1.50 to make it when you have 320,000 contracts.
That is not nothing. That is not nothing. So just something to keep in your hat there. Or if somebody has been short a lot of financials, I guess or has been short the XLF, they're plunking down some big dollars to try to cover it. But it doesn't. It looks like kind of a delta neutral backspread, or somebody got out of stock and into just a bunch of calls.
Yeah.
That would be what I would think. So that
it's more fun to think of someone that's some billionaire. Maybe it's Carl Icahn. He's bullish on financials.
I mean, he tends to buy undervalued stuff. I mean, he bought FCX at what? He wrote it down like what, $12 or $13 or something like that. And I know he's buying CHK. That feels it almost feels like, I know, pun intended, but a retail purchase for a guy like that. But
yeah.
But that doesn't mean he didn't do it. It is great to speculate on, though. That is awesome fodder for the show, and I'm sure Longo is going to be very happy with.
Of course.
It's hey, anything's possible. Now, going over, this is sort of the part of the odd block. This is the head scratching trade of the day in AMD, Advanced Micro Devices, is up 89 cents to $8.56, and it's making a 52-week high. At least when I wrote this up for Option Insider, the network. So, a 10% move in AMD, which happens never. Realistically, it just never happens. The stock was trading $6.40 3 days ago and is now trading $8.46. So really, really, really wild stuff as far as movement goes for this thing. So I believe the reason for the rally is somehow they're on NVIDIA's coattails. I'm not quite sure. It was I asked some guys in our chat room, and I think that was the reason. I think Microsoft is peripherally involved in that as well, because Microsoft had kind of a big move today for that stock. But this was the trade. So somebody puts up 19,499 Jan 7 puts for 35 cents, and they put up Jan 12 calls for a dime 20,588 times. So it normally trades, it's a pretty heavy trader, about almost 50,000 contracts a day. There was pretty good open interest on the calls, and about 20,000, a little over 20,000 calls, but the put open interest was small, only about 13,000 contracts. So the puts are clearly opening, and they were priced sort of in the middle of the range. The calls went up through the bid. So I think the bid at the time was 12 cents, and the calls printed 10 on 20,000 contracts. So you look at the Jan 12s, and you go, okay, the Jan 12s are $4 out of the money in a stock that never really moves. So it looks like somebody wanted to sell the strangle. The strangle closed 36-cent bid, and somebody sold it almost 20,000 times. The strangle closed 46-cent bid, and somebody sold it almost 20,000 times for 45 cents. So it looks like a strangle seller to open. Why you would sell the 12 calls for a dime, though, I don't quite know. This to me was a head scratcher, because if you're along the Jan 12s and now you're blowing them out for a dime, okay, I could see that as a trade. The put sale on the 7s Maybe somebody missed something. Maybe they own stock, but it's kind of a strange, all I can say is it's a strange ratio and it's a strange strangle. I don't know if you have any thoughts on that one, but it has strange written all over it. That's all I can say. No. And I know there's a Doctor Strange movie out, but this is not even closely related to that.
Yeah. This one's strange to me too, because you're selling a strangle, which is a neutral trade, and you're doing something where and this is a trade with which you don't want the stock to move, and you believe it's not going to move. But this is a stock that has gone from $1.75 to $8.77 is the range over the course of the last 10 months or so. So that's one where I guess I don't know if you're bullish, you think the stock's going to go up. If you're bearish, you think the stock's going to go down. If you're neutral, I mean, we when I was at Options Express, we wanted to coin a phrase for that. If you were really neutral, thinking the stock's not going to go anywhere, we never could come up with anything for that though. But if there ever is a term for that, if you're very, 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 very neutral on something, that would be an example of it, because you're betting on sideways movement over something that has been anything but.
The term I use for that is a lateral arabesque.
This person's very lateral arabesque.
I want to move sideways and then move sideways again, and after that, I'm going to move sideways again. That's my my big phrase for that. But it is I don't know. I never thought selling anything for a dime was a good idea. So that's just maybe that's the old.
Unless you're really, really, really laterally arabesque.
Unless you really want the, I guess it's the lateral arabesque trade. So not a, it probably, I would say you're looking at the movement. If AMD is back on the money-making train again, it used to be a big trader back in the 90s, as I recall. It actually made a move, I think, from the 30s to the 80s, if that's even possible to contemplate way back when. It was a huge trader. I guess so was MU, I guess, at the time. Both anyway, but those days are basically or not what is there. But I think AMD is trying to ride NVIDIA's coattails somehow. So we'll see how that all plays out, because I do know they make those GPU chips that are a little faster. So maybe they're catching a little bit of NVIDIA's tailwind. So lastly, we have Freeport Mc MoRan, ticker symbol FCX. It was up fractionally today to 1374. It's right near the middle of the 52-week range, but it is making a concerted move up and out from where it has been. I mean, it just traded $9 probably, I'm going to say 3 weeks ago, and it's trading $13.80. So I think this is another beneficiary of whatever the Trump momentum is for some of these stocks. What I did see was, again, probably a close. It's probably a close. Somebody bought the November 14 puts for 35 cents 10,000 times. So closing tomorrow. And also went up 500,000 shares of stock went up around 1376, which made this trade look like a synthetic straddle. If you buy 10,000 calls and you buy 500,000 shares of stock, you have a synthetic straddle. You could also buy 2 calls and 100 shares. I'm sorry, 2 puts and 100 shares of stock for a synthetic straddle if you so choose. You don't have to do it 10,000 by 500,000 shares. But they paid 40 cents for the 14. I think 46 cents for the November 14 synthetic straddle to close. I believe it was to close, unless they think something magical is going to happen tomorrow. I think they're just taking some risk off the table with 1 day to go, because, I mean, if they sold the puts in stock and you're essentially you're very close to being pinned to 14. They probably made most of the money they're going to make on this, and then from there, all they're going to do is, I think they're just ringing the cash register on that. That would be my first thought on that one. But it looked like I thought somebody was trying to bet on a potential, kind of lottery ticket type move tomorrow, but I think most likely just closing it and trying to avoid any problem of the trade moving away from the strike. So that was not as interesting or head scratching as the other two, I have to say.
Yeah, that one actually kind of makes sense. That's kind of a disappointment by odd block standards.
It is. It was a very strange day for volume. I saw, like yesterday, we saw a massive Russell butterfly go up. And one of my clients mentioned it, and it was a very interesting trade. But I didn't write it up for today's show. But they, a Russell butterfly, 10,000 times is a pretty huge option position. But surprisingly today, there wasn't a lot of crazy paper that was really, what I would say odd block worthy. I thought there'd be a little bit, but it's kind of back to the kind of grinding, boring market.
Well, in some ways that's good.
It's good if you're an investor.
Yes. All right. Well, that concludes the odd block for today. And now, get ready, folks. It is time for the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the strategy block.
And welcome to the strategy block. This is where I, yours truly, Mike Tusaw, discuss, well, of course, strategy. The strategy block is something to where I confide in Mark Longo's minions. Most of the time, they do a pretty good job in reporting back to him as to what the strategy will be. However, today, I had no minions, and since there's no minions, no Longo today either. So, with that being said, maybe Mark took his minions over to the teacher conference at his kid's school or something. Who knows? So, but anyway, what I want to go through today is something that I'll be talking about probably a little bit more in the near future on the show, and that is my trade in IBB. IBB is an ETF that tracks the biotechs. And this is not intended to be a recommendation by any means. I just kind of want to go through this as a way of giving you guys something to look at, to think about, and a way to help you possibly learn something for your trading. And this is going to be reminiscent of the Apple trades that I made in the years past. I'm not taking near the position that I had in Apple in years past, but however, if Apple did go down to 80, like I keep hoping it will, I'd gladly jump back on that train and have a lot more to talk about on Apple on the strategy block. But for the time being, we'll stick to the biotechs. So with this, a couple weeks ago, got into this trade. IBB was at the roughly 300. And to give you an approximate date as to when we started this journey, and IBB was at 300 probably around, actually back in September. So this is one that we've been kind of looking at for a while. Put on the collar for the 290, 310 collar. Just wanted to get a little bit of a position in it. Thought maybe it might break above the 300 level. Obviously, I was wrong, and wrong royally at that point in time. But the fact that you're collared kind of helps a little bit. Well, it helps a lot, as you can see, if you're looking at a chart of IBB right now as to where it went to from mid-September all the way to right before the election. It actually lost over $50. Now, with excuse me, with that, I'm in a stage, well, fear not, because of the fact that we have the put option in place. If the bleeding continues, well, it'll go to zero, and well, who cares? We're covered at 90. Or we can actually do something. And doing something is what I decided to do. What we eventually rolled into was IBB got down to roughly, when we actually started to do this, it was actually in October, was probably around the 270 level. So get in roughly 300. It's down at 270. Not in a great position by any means, but the fact that the stock is down 30, we're only down 10, that actually gives us some leeway as to what we can possibly do on this to make this work in some way, shape, or form. So about a month ago, we got into took profits from the long put for the October monthly, closed out the covered call for nickel, something like that, and went to work. The next collar that we did is we bought the November 255 put on IBB, of course, and we sold the November 280 covered call. Now, with that, you're thinking, oh, well, that's really not that big of a deal. All you're doing is that you're kind of holding down you're making it so you're locking in a loss. Well, yes and no. Yes, for those 100 shares, if indeed that's what we did it with, but no, because we actually bought another, and I'll just kind of ratio this off so that way it makes sense to everybody. For every 100 shares that we owned, we bought another 8 shares at that same lower level at around the 270 level. So now what that did by buying those additional 8 shares is that actually made the cost basis of this entire transaction, meaning if it goes to this level, we're totally break even on the trade. That made the break even point $278 per share. So with that, was still not still kind of concerned with IBB a little bit going into the election, but we had it carefully hedged. And this is one to where if we had some surprises, it did have some definite upside potential. And the big surprise is something that rhymes with thump. Someone whose name got taken down on some of his buildings recently, and that was the big surprise. The big surprise, of course, was that Trump won the election that we were not expecting. But it was a pleasant surprise for this trade because is what made this underlying go higher in value. Now, at this stage, we're actually going into expiration tomorrow. The 255 put is all but pretty much worthless right now. And the 280 call is skating right around intrinsic. It's basically around par value. There might be, just depending on the spread, you might be able to get a little bit of juice out of it, but there's little, if any, in there because IBB is trading around 288. So here's the good news on this. This is a trade with which the market went against me. It is, and it still is against me technically because we got in roughly around the 300 level. I forget if it was 299 or 300, but it was in the upper 290s is where we got into it at. It's in the upper 280s right now. So after this 2-month journey of being wrong, I'm profitable on the trade. That is the magic of options. And I'm profitable in that we're long 108 shares. The basis, because of the fact that we bought those extra shares at a lower level, lowered the basis to roughly the 278 level. And so because of that, we're profitable. Now, we're not profitable very much. We're only going to, assuming we get called out tomorrow at the 280 level, which if I take no action, we will be. We'll be profitable maybe $2 or so on the 100 shares, and we'll be profitable $10 on the 8 shares ratioed off. So we're not so uberly profitable, but we are profitable when the market went against us. Now, let me give you some ideas on what I plan to do with this. Tomorrow, I'm going to make a decision on this as to whether we're going to just let it get called away, whether we're going to try and roll it, whatever the case may be. But let's say that I decide to let it get called away. At that point, what I need to do is I'm looking to make those 8 shares totally free. I want to be able to create an environment or to create some type of a cost basis to where we've taken in enough money to where if IBB were to go to 0, then it would be meaningless, not meaningless, but it would mean that we wouldn't lose any money even if those 8 shares went to 0. I'm trying to create a way with which the market pays for those 8 shares. Now, we've all heard about dollar cost averaging, and I've talked about this on the show a lot. Do your dollar, there's ways with which if you use collars and get the right movement, you can use the market itself to create your own form of dollar cost averaging, and that's what we did here. So ideally, let's say that I get called away. What I'll be looking to do is sell some type of a protected put spread because I want to keep the spirit of the collar alive, so to speak. Let's say it expires at 285 tomorrow and I let the 100 shares get called away. Come Monday, what I'd be looking to do is possibly maybe a 280, 260 put spread to where we can get some income in some way. And I'm just throwing out numbers here. I'm not going to make a decision on this right now. Obviously, I want to see what the market gives us tomorrow. But I'm probably not going to get back into it because at this stage I want to collect some premium and I'd like to get back into it on my terms. That's kind of how I'm looking at this covered call. And if it keeps going higher and higher, well, that's great because ratioed off, I got those 8 shares that we still have exposure to. Now, let's say that tomorrow it expires at 279.99, the ultimate covered call trader's dream expiration. And if that's the case, I'll buy back the covered call for a penny because, of course, that's exactly what it's going to be trading at 1 minute before the close. Not. But let's just say that I do that. What I would then do is reinitiate a collar probably in the 270, 290 range or maybe even the 260, 300 range. And let's say that I did the 260, 300 range for a collar. Stock goes up to 300. And the same scenario happens again next month, let's say. Well, if that's the case, then all of a sudden at the 300 level, if I were to sell those 100 shares, that means that I sold them at the original price with which I bought them. I'm break even on those original 100 shares. But wait, I bought those 8 shares at a lower level with put profit. That means that those 8 shares are totally free. So what I'm trying to do here, folks, is use dollar cost averaging with the market's money. That's the ultimate plan on this. That's what I'm trying to do. And I'm excited about the new journey in IBB. I think it does have some upside potential. I don't know if it'll necessarily be as explosive as Apple was back in the a few years ago when I was constantly doing strategy blocks on Apple. But I think this could have some potential to be pretty exciting, and I will keep everybody posted and updated on the journey. And that is the strategy block for today, November 17th. All right. And now let's move on to the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right. We have some mail for today. Andrew, are you excited to answer some mail?
I am. I'm still recovering from the strategy block, just being totally mindlessly blown away. So, but I'm ready. I'm totally ready. All right.
Excellent. Well, I mean, what are you going to say? You're on the air. You're going to say, no, I really don't care. Who would ever say that?
Sebastian would.
He probably would, actually.
He would. Like, yeah, I don't care. Let's go on to something else.
All right. Question from, okay, now I have to say this is possibly my new all-time favorite handle for this show. Question from Mike The Bookie. The ETF based on volatility indexes, is here a good place to bracket UVXY or VXX?
My first question is, what does bracket mean?
I'm assuming he means collar.
Collar it?
That's my guess.
So you want to buy those products and then buy a put and sell a call against it?
Either that, or perhaps he would short those products and do the opposite.
I would say no. The problem with, I think if you're buying the vol products, those vol ETPs to try to catch the bottom in volatility, the problem is they don't buy the VIX, they buy the VIX futures. So what we try to explain to people in Option Pit is it's almost like buying, when you buy those products, it's like buying an option. They're going to decay. The only time they're really fun to buy is when volatility actually starts to move up again. So you could spend an awful lot of money buying those. So as far as putting a collar around those things, basically, yeah, you could put a collar around it, but all that does is really turn UVXY or VXX into a call spread synthetically. And and when you buy call spreads and the underlying goes down, you still lose money. So, I mean, I think there's a lot of better ways to trade them. Of course, that's what we teach at Option Pit, better ways to trade the vol products. Mostly as a long, I just stay away from them until, volatility actually starts moving up. When the VIX futures start doing interesting things, they get a little flatter. And then those products actually really have a chance to take off. So the problem is you could be, sort of finding new bottoms for those products for a while. And, today's a classic example. VIX is down 37 cents and UVXY is down, what was it down today? It's down 78 cents. VXX is down 87 cents. So it's not that they can't bounce, and they do, but normally, you need to see vol really moving, and you could choke on a lot of UVXY and VXX before they actually start moving up again. So the collar is probably, again, I don't think it's a great choice for these products. The only thing that really they're going to help you do is that you just lose less money, if that's what you mean by bracketing the position as Mr.
Right,
Tusaw.
bracketing could be a lot of different things, so that's just a total guess. So Mike the Bookie, if bracket means something else, feel free to write in again, and we'll try to clarify it. All right. Now, next one. This is from Ian. Ian wants to know, I think this is a good question for you, Andrew. Why trade volatility versus direction or income? Is it a preference, or do you feel it's a more favorable risk reward? What are some of your thoughts on that?
Well, I guess the income trade is a very interesting concept because you need to sell something. So I guess if you buy a call and you make money on it, that's not income. That's something else. But the reason why I like volatility, and that's what we spend a lot of time trading, is because of the characteristic of it. It's the volatility is mostly reverting. It does not go up forever. It doesn't go down forever, although it can do it for a while. It tends to be a more reliable trade if you're going to trade options in the way I'm used to trading them, which is basically kind of delta neutral, and you sort of buy premium and you sell premium, and you're looking to make money on trades you can find edge in. Income trades, basically you just sell puts or something until they go out worthless. I mean, that works for a while. I think it's great if you want to own stocks, but just selling them and then waiting until they go out worthless and then, selling them again. You do that, and you have one bad sale, and it kind of just eats away all the money. So I think that is a difficult position. The problem with a lot of income trades is you end up selling options for so little money relative to what the actual movement is worth that you sometimes it's all better if you don't sell them, because they're too cheap to sell relative to basically the realized fall of the underlying. They're poor sales statistically. So as Don would say, there's some options are meant to be sold, but then there are others that aren't. Those are his two big choices, which are fine. But when you separate, an income trade from trading volatility, I think it's ultimately it's you can trade volatility because it can get a little more expensive and it can get a little cheap. And it also creates a lot of opportunities for the ways that options actually naturally work, where you pick up a lot of what we call a lot of the Greek risk in an option, where a change in volatility does an awful lot to the way an option moves, or a change in the underlying velocity or acceleration does a lot in how an option moves, which you don't really, if you're using it kind of as income, you don't quite get that. So what it does is volatility gives you, or understanding volatility gives you much better edge to initiate a trade. Just using options to trade directions, you certainly can do it. I have met people that are pretty awesome at direction, but after doing this for 25 years, I've only met like 2 or 3 of all the people that are great at it. And I would guess those 2 or 3 are pretty fantastic, and the other 99% of the people aren't that good. So the thing with, trading vol is you take a lot of the direction out of the position. So you can do it, but I think once you learn how volatility works and how it affects options, it's a more reliable trade. That's ultimately the reason why I like it better.
Makes much sense. All right. Well, we do have a lot more questions to get to, but unfortunately, we are out of time for today. So with that, we're going to shift this into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, Andrew, at the option pit, what are you guys looking at going into this weekend and into the Thanksgiving holiday week?
Besides looking at the bloodbath in the shipping companies, those dry ship companies that went up, up $80 and then back down $60 and all kinds of crazy things. We looked at that for a while. It seems like whatever craziness has happened subsided. But mostly, can the financials keep pushing the market along? What will happen with interest rates? But I think they're going up. And, how whatever the new White House, how that affects economic policy. Right now, there's kind of that winner and loser market. It's still, although technology is coming back, but in order for Tusaw to say his famous phrase, I think technology is going to have to start helping a little more to make that happen. And same with the oil patch. I think there's a couple of, those are still too big, although oil stocks are up, considerably this year. The price of oil still has to stabilize so we can push those numbers higher. But, now that Yellen says she's going to raise, I think mostly I want to see how low volatility can go and if we could actually see a 12 handle for the VIX, and even this week.
It's not out of the question by any means. I mean, like the other thing that I'm watching that I think has definitely helped the oil stocks a little bit this year is natural gas. Natural gas, long story short, when companies dig for oil, they basically take whatever they get. If they get oil, great, they'll go sell some oil. But if they get natural gas, great, they'll go sell some natural gas. It's a lot more complicated than that, obviously, but they both, a lot of them have exposure to both. You look at the price movement of natural gas throughout the year. It opened the year, roughly around $2.30, but it did get as high as $3.30 at one point. It was as low as $1.60 back in March, but we have had a little bit of an uptick in natural gas. So I'm going to be watching. It's kind of in the middle of its peak to trough range over the course of the year. So not necessarily this weekend. I'm not expecting a huge move in it, but over the course of the next few weeks, I think it could be interesting, not only based on the stocks, the commodities, and the natural gas itself, but we got winter coming on. And if we have a cold winter, that's something that could also affect it. Other things, we got a ton of earnings that we're looking at that are coming up. Let's see. We have Walmart was today, I believe. Best Buy, Salesforce. Tomorrow we have Foot Locker, Abercrombie & Fitch. So a lot going on, a lot to talk about, and can't wait till Monday on our next show. But in the meantime, is there anything that our audience can do over at the Option Pit, Andrew, to just kind of tide them over between now and our next show on Monday?
Oh, wow. I wish we had they could always check out our goodies at Option Pit, or they could, will be able to sign up for, we're going to teach people about trading options in a rising interest rate environment. We haven't had one of those since I was a youngster, about 20
The return
years
of Roe.
The return of Roe. So we will have a Saturday class, I believe in 2 weeks, on that very subject to help you understand what interest rates do to option prices. Especially what they do to long-term option prices, because it makes actually kind of a nice little difference. And also what that does to, I think volatility going forward. So it's It will be a good class. Of course, you learn a lot if you just become an Option Pit Live subscriber or higher. You get our Saturday classes for nothing. So that's a pretty good deal as far as I'm concerned.
I would agree. All right, and over at RCM, if you are looking for a place to trade, back in the 80s they had the Take the Pepsi Challenge. Well, I'm going to give you this: Take the Commission Challenge. You might be paying a higher level of commission where you're at right now. You might not be. But give me a call. Let's take the commission challenge at RCM. We do have over $100 million of assets under management. So we do get some preferred rates from the places that we use, MoneyBlock, TD Ameritrade, Interactive Brokers. And so if you are looking to possibly save some money on your trades, as well as have the ability to call and ask for advice on trades from time to time and make it a save money win-win scenario, give me a call and take the commission challenge. My number, and I can tell you exactly what our rates would be versus what you're paying, and we might be able to figure something out that could help you. Feel free to give me a call at 312-212-3531 or shoot me an email at mtosaw@rcmfs.com. And on that note, we would like to thank you for listening today. Make sure you go to theoptionsinsider.com to download all your shows, or if you want to be really cool like me, get the Options Insider app. I think it's a phenomenal app. I think it's Mark and the guys over there did a great job on it. That's my personal favorite. I know there's other ways of seeing the options block and other ways of going to the Options Insider through Stitcher, AHA Mobile, and all those other things that I don't understand. But with that, I can give you my personal endorsement. The app is phenomenal. So on that note, I'd like to thank everybody for coming today. Wish everybody well, and let's have a great weekend. So long, everybody.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.